Good morning. This is Judge Keith Long speaking. Before we get started, may I ask everyone to mute their microphones when they are not speaking? You should see a microphone icon on your video screen, which allows you to mute and unmute easily. I'm the lead ILJ conducting the hearing today for this case. On this panel are Judges Lambert and Judge Quee. Because of the ongoing concerns pertaining to the coronavirus and consistent with the governor's executive orders, the Office of Tax Appeals has decided that it is in the public's best interest to move the Office of Tax Appeals calendar to video conferenced hearings. We're holding these hearings via video conference with the agreement of both the taxpayer and the agency's representative, and this change will not impact the fair and objective hearings of the tax appeal. If you are unable to connect or have technical difficulties, you may call in using the telephone number that was provided earlier. Thank you for your patience and flexibility during this time. This hearing is live streamed to the public, and the audio of this hearing will be transcribed. As this hearing is being live streamed to the public, please do not show your exhibits on the screen. Additionally, please do not use the chat function within Webex. To minimize confusion during the hearing, we ask that participants mute their microphone, and when they are speaking, please repeat your name and avoid talking over other participants. If there are any questions during the process, including any questions regarding the technology, the questions should be directed during this call to me, the lead administrative law judge on this appeal. If you become disconnected, please contact Claudia Lopez. We have a couple of administrative matters before we go on the record. The Office of Tax Appeals is an independent and neutral agency. It is not a tax court. All three judges are co-equal decision makers, and we can all ask questions at any time. With respect to the exhibits, taxpayer has previously submitted exhibits 1 through 9, and CDTFA has submitted exhibits A through G. At the July 2nd pre-hearing conference, there were no objections to any of these exhibits. Mr. Lyon, can you please confirm that that is still the case for the taxpayer? Mr. Lyon, you're muted. Mr. Lyon, you're still muted.
Okay, now do you hear me?
Yes, we can hear you.
Sorry, I was abiding by your instructions. Yes, that is still the case.
Great. And CDTFA, can you please confirm that that is still the case?
Yes, that is correct.
Great. And at issue in this case is whether appellant is entitled to a refund of use tax paid on the transfer of vehicles from its parent company. As discussed at the pre-hearing conference, the transfer from construction to CPC is not in dispute. Is that still correct, Mr. Lyon?
Correct.
And CDTFA, is that your understanding as well?
Yes, that is correct.
Great. One moment. As we discussed at the pre-hearing conference, oral hearing will take approximately 1 hour. We'll start with the appellant's presentation in 5 minutes. There will be panel questions after appellant's presentation. CDTFA will have an opportunity to make its presentation, approximately 10 minutes. Again, there will be panel questions, and then the appellant will be given time to rebut CDTFA's presentation. Afterwards, there will be panel questions and any closing remarks. Is there any final questions before we go on the record, Mr. Lyon?
No.
CDTFA, are there any further questions?
No questions. Thank you.
All right. Are we all ready to go on the record? We are.
Yes.
We are now going on the record. This is the appeal of CPC Transportation Company, LLC. OTA case number 190-64866. Date is Wednesday, July 22nd, 2020. Time is approximately 10:06. This appeal was intended to be heard in Cerritos, California. I am lead administrative law judge Keith Long. And with me today is Judge Josh Lambert and Judge Andrew Quee, and we will be hearing the matter this morning. I am the lead ALJ, meaning I will be conducting the proceedings, but my co-panelists and I are equal participants, and we will all be reviewing the evidence, asking questions, and reaching a determination in this case. Parties, please state and spell your names and who you represent for the record. We'll start with appellant, Mr. Lyon. Mr. Lyon, you were muted when you started talking.
You can hear me now? Okay, thank you. This is John Lyon. I'm representing the appellant CPC Transportation Company.
Thank you. And CDTFA?
This is Jared Noble representing CDTFA.
My name is Stephen Smith, also representing CDTFA.
And Jason Parker with CDTFA.
At issue today is whether appellant is entitled to a refund of use tax paid on vehicles transferred from its parent company. Taxpayers submitted exhibits 1 through 9, which are admitted into evidence with no objections. CDTFA has submitted exhibits A through G, which are admitted into evidence with no objections. Mr. Lyon will begin with the appellant's opening statement. You have 5 minutes. We will begin when you're ready.
Very good. Thank you, Judge Long. As an introduction, as you stated, at issue today is the transfer of vehicles from the appellant's parent company, Cal Portland Company, to the appellant in 2009. The tax at issue was originally assessed under audit and a refund claim was filed. Appellant believes that CDT has misinterpreted guidance to hold that a transfer from a parent to a subsidiary is taxable in the same manner as transfers between wholly owned subsidiaries. Appellant further believes that there is no indication that any consideration was paid or received under what we believe the appropriate standard of proof should be as the reasonableness standard of proof. I would like to briefly just describe what each of the exhibits contain. Exhibit 1 is a balance sheet of CPC Transportation, the appellant, as of 2009. And overall, the company of which CPC Transportation is a subsidiary, overall, the company operates on a consolidated basis with the accounting entries between entities made through an intercompany control account. But during the course of the audit, this balance sheet was created for the appellant on a standalone basis. As you can see, that the components of it consist primarily of assets, non-current receivables, current liabilities, and stockholders' equity. Exhibit 2 is a trial balance for the appellant for 2009, which provides the detail entries that roll into the balance sheet. And you can see on Exhibit 2 that the primary components are assets, which is primarily auto and truck equipment, which are the vehicles at issue primarily. Current liabilities, which is primarily AP voucher entries. And then non-current assets, which is largely consisting of the intercompany control account. Exhibit 3, in turn, provides the detail of the intercompany control account. You can see that on the credit side of the transactions, you have primarily auto and truck equipment, which is the transferred issue, assets under construction, payroll, and diesel fuel. On the debit side, you have freight revenue, because this entity provides freight services for the parent. Exhibit 4 is a journal entry of the asset transfer in 2009, which is hitting the auto and truck equipment account and the transfer of a cost of $1,672,000. And with depreciation, that's a net book value of the transfer of $1,009,372, which is the amount that was the basis of the assessment. Exhibit 5 is images of the DMV titles and registrations of all the vehicles that were transferred. As you can see by scanning through the various pages, that there was no lien holder and thus no debt was transferred with these vehicles. Exhibit 6 is a declaration under perjury of the Chief Accounting Officer, Matthew Hisson, who states that with respect to these vehicle transfers, no debt was assumed, no intercompany payable was created, no additional ownership interest was given, and rather the vehicles were contributions to capital. Exhibit 7 is simply the audit manual, which you should be familiar with. This audit manual section is referenced in the supplemental decision and states that property transferred to an existing LLC for which no additional membership interest is given is not subject to tax, even if that interest is increased in value. Exhibit 8 is a section of the audit manual that simply describes that a reasonableness standard should be used in questions of judging whether or not a resale certificate was taken in good faith. Exhibit 9 is an annotation that provides that consideration consists of assumption of any of the parent's liabilities and intercompany debt, the cancellation of indebtedness, or the parent's receipt of additional shares in a subsidiary. Now, to briefly provide an analysis, a summary of our position, appellant believes that as shown by these exhibits, that there is no evidence of any consideration having been paid on the transfer between the parent and the appellant. However, the CDTFA has characterized any entries to the intercompany control account between parents and subsidiary as consideration. And to overcome this characterization, the CDTFA is requiring an appellant to prove a negative that in an area where there is no express guidance with respect to what documentation must be provided to make this, to show this. Therefore, the sole issue is whether the CDTFA has erred in concluding that a transfer of assets from parent to subsidiary is taxable, where there is no indication that consideration was paid or received. Rather, the available evidence shows that there were no existing liabilities assumed, no new debt was created, and no additional ownership interest was received by parent. Specifically, footnote 4 of the supplemental decision references that it concurs that with the audit manual section is saying that no additional membership or other consideration is given, even where the value of the existing membership is enhanced, is not subject to tax. Page 10 of the supplemental decision confirms that no additional ownership interest was received, and also that the 2009 trial balance does not show any direct liabilities resulting from the vehicle transfer. However, there are quote unquote other expenses and accounts cleared through the intercompany account. However, when you scan through the intercompany control account detail, which we provided as Exhibit 3, all comparably sized transactions that could possibly be related to the transfer of the vehicles include payroll, freight revenue, and diesel fuel, and none of these appear to be related to the transfer in any way.
Mr. Lyon?
Yes.
I don't want to interrupt, but it has been 5 minutes. Can you just take the next 2 minutes or so to wrap up?
Yes, I think that's, I'm sorry, about 2 minutes is about it. Thank you.
Okay.
Another way to cite the issue would be, is it appropriate to treat any entries to an intercompany control account between parent and subsidiary as consideration, even when all such entries are clearly not related to the transfer and thus not indicative of there being consideration? The CDTFA, the supplemental decision references the Payne versus State Board of Equalization decision as requiring that we affirmatively prove no consideration was paid. However, that case dealt with the providing of exemption certificates, which are clearly laid out in Regulation 1667 and Audit Manual 0409.05. There are no such established requirements for a transfer such as this, and we therefore feel that a reasonableness standard should apply in evaluating the evidence. In summary, contrary to the CDTFA's position, we believe that a transfer from a parent to a subsidiary is not comparable to transfers between subsidiaries simply because the parent has an ownership interest in the subsidiary, and accordingly, a transfer such as this simply increases the value of its existing investment, which is expressly excluded from the definition of consideration under Exhibit 8. And that is the end of our statement.
Thank you. I'm going to turn it over to my panel members to ask any questions they may have. Judge Quee, do you have any questions?
Yeah, I guess I do have one question. There seems to be a lot of focus on annotations and what they say about transfers between a parent and a subsidiary or sister corporations. But from my understanding, we do have some court cases that discuss this issue. For example, there's the MAPO Inc. versus the State Board of Equalization, and there's Macrodyne Investments versus the State Board of Equalization. And I think those stand for the general rule that you have to treat different entities as separate legal entities. But then there are some circumstances that the court has carved out where you would allow transfers between a parent and a subsidiary to basically qualify as non-taxable. And then there's factors that you look at. For example, the length of time the corporations have existed, if there's a separate business purpose, the formalities, if they're observed, if there's basically how distinct they are. And I'm just wondering if basically the rules set forth in MAPO Inc. versus State Board of Equalization, if that's something that's been considered, and if those factors specifically have been considered as applicable in this case, or if that's distinguishable from this case, or if the parties have a position on that.
I'd have to review that case, I'm afraid, and get back to you on that.
Okay. And I did have one clarification question. Is the taxpayer a 100% owned by the parent, or is there different than 100% ownership?
I believe they're 100% owned. Tyler, could you confirm, please?
Yes, they are 100%.
Okay, and just one other question before I turn it back to the lead judge. So is there any dispute or contention that the parent transferred all or substantially all of the assets to the subsidiary, or is it conceded that this did not qualify as basically a transfer of all or substantially all of the assets of the corporation to the subsidiary?
No, Judge Quee, it was not substantially all the assets. It was a limited number of vehicles, and it was not the entire assets of the parent.
Okay, thank you. I will ask that question of CDTFA after their presentation if they don't incorporate it into their presentation, but at this point I will return the question to the lead judge.
Judge Lambert, do you have any questions? Judge Lambert, you're muted.
I have no questions. Thank you.
Okay, I did have one question regarding the transfers of the vehicles. I'm sorry, can everyone mute their microphones, please? There's a lot of feedback. Thank you. Regarding the transfer of the vehicles, I know that we have the titles and also the balance sheets in the exhibits. Was there just no paperwork for the actual transfer from the parent to the subsidiary? Did they not record it anywhere? Is there no understanding or contract? Mr. Lamb?
I don't believe so. Tyler, could you help me with that answer?
Correct. There is none. If it was a sale, if it was a true sale, there would have been an invoice and such. This was just a capital contribution. And let me point out that it was brought up that the intercompany accounts, and that was considered by the state as consideration. That's the only way that you can do it on SAP, which is our accounting system. There's no other way that you're able to do it unless you would as a sale, which it was not. So the only way is the intercompany, which eliminates out when you have 100% ownership in the SAP accounting system. It's just the way it is.
Okay, thank you. I don't have any further questions. I will turn it over to CDTFA for their presentation. CDTFA, you have 10 minutes. Go ahead.
There is no dispute that Appellant is a single-member LLC that commenced operation on or about April 4th, 2008, and that Appellant is wholly owned by Cal Portland Company, and that Cal Portland Company also wholly owns another corporation called Cal Portland Construction. There is also no dispute that on December 31st, 2008, Cal Portland Construction transferred vehicles to Appellant with a total value after depreciation of $3,023,945, and that on June 30th, 2009, Cal Portland Company transferred vehicles to Appellant with a total value after depreciation of $1,093,793. The transfer of these vehicles in California occurred in California, and Appellant did not remit use tax on these transfers at the time of registration or on its sales and use tax return.
I'm sorry, there's a lot of background noise.
It's not coming from me.
Is there? It looks like we're all muted now. So I think go ahead, Mr. Noble. If you could take it back like 30 seconds, that would be good.
Okay, no problem. There's also no dispute that on December 31st, 2008, Cal Portland Construction transferred vehicles to Appellant with a total value after depreciation of $3,023,945. And on June 30th, 2009, Cal Portland Company transferred vehicles to Appellant, total value after depreciation of $1,093,793. Transfer of these vehicles in California, an Appellant did not remit use tax on these transfers at the time of registration or on its sales and use tax returns. Lastly, as stated before, there is no longer any dispute that 2008 vehicle transfers from Cal Portland Construction are subject to use tax. Under the sales and use tax law, every person storing, using, or otherwise consuming tangible personal property in this state is liable for use tax. And is relevant to this case when a vehicle required to be registered under the vehicle code is sold at retail by other than a licensed vehicle retailer, the purchaser shall pay the use tax to the DMV. The law provides that a sale and purchase includes any transfer of title or possession of tangible personal property for consideration. Civil Code Section 1605 states that consideration is any benefit conferred or agreed to be conferred upon the promisor by any other person which the promisor is lawfully entitled, or any prejudice suffered or agreed to be suffered by such person. There are several sales and use tax annotations that address the application of tax to transfers of tangible personal property between related entities and what constitutes consideration. For example, annotations 395.1258 and 49.0748 both provide that the recording of debits and credits in the internal accounts of related entities in relation to the transfer of property is consideration, and such transfers are subject to tax. In addition, we note that the pending OTA precedential opinion for the Martinez Steele petition for rehearing, citation 2020-OTA-74P, provides that annexations are entitled to great weight when CDTFA is construing a statute it is charged with administering, and that statutory interpretation is longstanding. According to Exhibits 3 and 4 to the appeals decision, and as attached as Exhibit A to the department's brief, the intercompany control account shows that Appellant recorded the vehicle transfers from Cal Portland Company as debits and credits. In addition, according to Appellant's year-end trial balance sheet attached as Exhibit 5 to the decision, it appears that Appellant and Cal Portland Company balanced revenue and expenses through the intercompany control account. These records establish that appellant incurred intercompany debt for the transfer of the vehicles and owed corresponding intercompany credits to Cal Portland Company. These debits and credits in the appellant's internal books are consideration within the meaning of the law, and thus claimant made purchases of vehicles subject to use tax. Furthermore, we note that appellant has conceded that the 2008 vehicle transfers from Cal Portland Construction are subject to tax, and that the records for those transfers are the same types of records remaining at issue in this appeal. With respect to appellant's assertion that the annexations are distinguishable from the facts in this appeal because the transfers at issue involve a parent and a subsidiary rather than only subsidiary companies, we note that annexation 495.0736.850, which deals with transfers from a parent company to a wholly owned subsidiary, states that sales or use tax does not apply when there is no consideration involved in the transfer, but does apply when there is, as relevant here, intercompany debt. As previously noted, the intercompany controls debits and credits for the transfers at issues, which is consideration. With respect to Audit Manual Section 1001.10 and Annotation 395.0078, we note that they provide that capital contributions to an existing LLC are not subject to tax if no shares of stock, interest, or other consideration is provided. This type of transfer is not subject to tax, even if the value of the shares or interest held by the person contributing the property is enhanced. Here, there is no evidence that the transfer of vehicles from Cal Portland Company was solely paid in capital that resulted in its ownership interest in appellant being enhanced. Instead, the records establish that debits and credits were recorded. Lastly, Rules for Tax Appeals Regulation 35003, Subdivision A, states that except as otherwise specifically provided by law, the applicable burden of proof is upon the taxpayer to prove all issues of fact by a preponderance of the evidence. Accordingly, appellant's assertion that a reasonable test should be applied to this appeal is incorrect. For all of the aforementioned reasons, appellant is liable for use tax on the vehicle transfers at issue. Thank you.
Thank you. I'm going to turn it over to my fellow panelists for questions. Judge Clee, do you have any questions?
Yes, so I had asked the taxpayer's representative about the court cases dealing with transfers from related entities, parents to subsidiaries, the MAPO Inc. versus State Board of Equalization, the Macrodyne Industries versus State Board of Equalization. I believe there's another case at Beatrice Co. versus State Board of Equalization, and they set forth usually the default rule that transfers of this nature, you have to respect the corporate form, treat them as separate legal entities. Generally, it doesn't matter if there's 100% ownership, but then there are certain circumstances where you would basically disregard it, but those are very limited circumstances, and I'm wondering if that's something that's been addressed or examined by CDTFA to determine if this is one of those situations, or if the facts make clear that it's not one of those situations, one way or the other.
Yeah, MAPO basically stands for the general rule that transfers between parents and subsidiaries is a sale. They are very narrow exceptions when sales would be disregarded. Here, with the facts in this case, the corporations have been formed for a while. They appear to be maintaining corporate identities, and they appear to have independent business purposes for the separate corporations. So we don't think that the limited circumstances or exception to the general rule described in MAPO is applicable in this appeal.
Okay, thank you. So I'll turn it back to Judge Long at this point.
Judge Lambert, do you have any questions?
I have no questions. Thanks.
I also do not have any questions. So at this time, we'll turn it back to appellant for rebuttal. Mr. Lyon, you requested 5 minutes for rebuttal. You may begin at any time.
Thank you, Judge Long. Two of the annotations that the CDFA referenced were 395.1258 and 495.0748. I would just like to point out that 4950748 does relate to transfers between wholly owned subsidiaries and not apparent to a subsidiary. And that it states on the second page of the annotation that the creation of intercompany debt is consideration, which we don't have here. There's no indication of it with available evidence. I would, with respect to annotation 3951258, this also deals with transfers between different operating corporations. It's not real clear, but it appears to be between subsidiaries, not apparent to a subsidiary, because they're transferring TPP between operating entities. But the important thing that I'd like to point out there is that on page 4 of the annotation, it states in the third paragraph that there may in fact be an explanation for the book entries made between the entities, and the department offered to review those and see if those entries had an explanation and other than being consideration. So I would like to point this out, that this supports the idea that book entries by definition or automatically are not necessarily consideration. It depends on the nature of those entries. And I would just point out again that in the balance sheet and the detail trial balance accounts and the intercompany control accounts, there's no indication of any transfers of the comparable size that an intercompany debt was created. All of the transactions that are of a comparable size are unrelated: revenue, payroll, other entries. No, there's no indication of the debt. That's all I had in response. Thank you.
Thank you, Mr. Lyon. Judge Quee, do you have any final questions?
No, I don't have any further questions. Thank you.
Judge Lambert, do you have any final questions?
No, thanks.
Okay, thank you. Thank you, Mr. Lyon. We now have appellant's evidence and the information that was provided today. Is there anything else that you've prepared or anything else you would like to tell us before we conclude the case?
Yes, thank you, Judge Long. I would just like to state as a conclusion that we believe there is the nature of the entities that these assets transfer between is significant, simply because there's already existing ownership interest by the parent in the operating entity. And when a transfer of this type is made at the consolidated level, it doesn't change anything. You're just transferring equity from one entity to another. And it simply serves to increase the value of the parent's ownership interest in the subsidiary, which I think if that is all that is occurring with no additional shares or no other debt being created, the simple increase in value of the existing ownership interest is not consideration under various guidance that are available.
Thank you. Well, this concludes the hearing. The judges will meet and decide the case based on the documents and testimony presented and admitted as evidence today. We'll send both parties our written decision no later than 100 days from today. Thank you for your participation. The case is now submitted and the record is closed. The hearing is now adjourned. Thank you.
Thank you.